Okay, I'm going to say that for everything from now on. Okay, so I'm here with two of our portfolio managers, Phuong Nguyen and Mike Nguyen. And so, so much of what we've done this morning is talk about the opportunity, we've talked about the markets, and now what we're going to do is we're actually going to talk about how we actually manage money. We're going to talk about, thank you, two of the different portfolios we have for international investors. And so we have two portfolios, and they're a little bit unique. So one, on the left we have, I'm going to stand for this. There we go. On the left we have VVF, which is a Luxembourg UCITS fund, daily liquid. And as you can see from the performance, year to date it's done very well. This is through the end of September. 15.3 versus the index at 11. 1 year beats it. 3 year 17.4 versus 6.7. And so, as Tu mentioned earlier, we've been able to deliver alpha in the short term, medium term, and long term. And as we talk about also, the opportunity for us to drive alpha is from different parts of the market. So for VVF, we're looking at small cap exposure of about 10%, mid cap at 45%, and then active share, which is a measure of how different are you than the index, is at 65%. And so Mike is responsible for day-to-day managing the UCITS portfolio. Then we also have something called VAF, which is a Cayman feeder. So as we talked earlier about the foreign ownership limits, VAF feeds into a local Vietnam domiciled fund called VSAF that Phuong manages as well. So year to date, that's at 25% versus the index at 11. 3 year at 19.8 versus 6.7. It's monthly liquid, feeds into Cayman. Here's where the big differences are. The small cap exposure for VAF and the underlying fund VSAF at 49%, mid cap at 24%. So again, really focusing on small and mid with an active share of 89%. So again, looking at that versus the Vietnam index, completely different story. And so what we're going to do for the next half an hour is really ask about how they build the portfolio, what type of themes they look at, what type of stocks they look at, and most importantly, why. So Phuong, we'll start with you. Can you spend a few minutes explaining how, really the VAF portfolio strategy, and then how is this strategy expressed in your top 10 holdings?
Thank you, Eric. For VAF, we actually apply a bottom-up stock selection. So ideally, we're looking for companies that can deliver an earnings growth of at least 3 times of GDP growth of Vietnam. So as Eric pointed out, VAF portfolio is mostly focused on the small mid-cap stocks that account for over 70% of the portfolio. So as you may know, in Vietnam, the small mid-cap stocks are usually overlooked by the investors because of the small size and many issues. But we think we have the advantage in local expertise. So we get in touch with the company management very frequently. We do a lot of channel check to make sure that they have sound business fundamentals and also good management. That brings us a lot of alpha. So as we focus on the growth, here we divided the small mid-cap space into 3 groups, which is where the earnings growth or the upside potential is driven by. The first group include the companies that are very perfect company. They are the stars in the market. They have strong business model, and so they have, because of the small mid-size, so they have some of the niche competitive advantage in the market, and it helped them to grow market share gradually. That is reflected all in the consistent growth in both revenue and earnings. So these are companies often in a good industry. So the tailwinds of the industry which they are operating in help them to shine year over years. The second group is the companies, they are not perfect. Actually, they did not pass through our screening criteria for some of the criteria. If we look in the past, usually they have low efficiency, low profitability. But when we look into the company, we see that they have some strengths and especially valuable asset. In Vietnam, it can be that they have large land bank, they have skilled labor force, they have good facilities in good locations, or they have business track record. So all they help them if when we get in touch with them very frequently, and then we know there's a turning point for them where they got new projects or the regulations change, so that's how they can improve the efficiency and also the profitability when we look forward. The third one, I think in Vietnam, mostly they are cyclical stocks with very volatile earnings. But we think we have some opportunity in entering them at a good point when the industry dynamics turn positive. So together, three groups. The first group account for 60 to 70% of the portfolio, and the rest around 15 to 20% each. That's about the.
How does that look? Your top 10 look like?
Okay. When you look at the top 10 holding in VAF, here it tells a lot. It shows that we mainly focus on small mid-cap first, and even with the two top holdings, FPT and MBB, actually they were both mid-cap when we purchased, and because they are in group one, so we have helped them for more than since our inception. When we look here, we see that when we choose a company, normally we will base attention a lot to the growth so that the portfolio total growth will exceed that of the broad market. And talking about that is not only about growth, but when we talk about small mid-cap, we'll always pay attention to valuations because sometimes it will be flows that driven the market up and then give us a lot of volatility. But then for the portfolio, we balance between growth and valuation. That is how the PEG of the portfolio, when we look to 2024, is around 1.4, which is a half of the broad market. That is how we structure the portfolio. And most of them are group one. Sometimes in the future, the group 2 and 3 stock will become group 1 when their earnings and efficiency turns good as group 1 stock as we purchase. And here we have example of FPT, leading company in technology. They have both industry tailwinds and leading position and help them ability to sustain a double-digit earnings growth through years. Yeah.
Okay, sorry. We do have a clock here.
Okay.
All right. So, Mike, I'm going to pose the same question to you because we have a few more slides. So, how do you build a portfolio? Similar approach, but also different. So, maybe explain your 3 categories and then how that manifests its way into your top 10 as well.
Sure. As you can see, our approach is quite similar to VAF in the sense that we break down the portfolio into 3 portions. The first part, the core portion of the portfolio, around 70 to 80% of the portfolio, we try to identify the company that can deliver sustainable long-term capital employed, return capital employed. The number we are looking at is around 20% for long-term. The rest of the portfolio, around 20 to 30%, will be divided between cyclical and opportunistic. Cyclical here, it means that actually we don't want to focus on the commodity price or either the weather, we don't forecast that. But what do we mean here? For example, in this particular case, we identify company that part of the business will benefit from the upturn in the cycle, while the underlying business is very strong. So in this case, we have a company that have very strong dominant market share in soy milk, which is very stable business. And the other business is the sugar business who benefit from the sugar price hike. So we make sure that at our entry price, the valuation only reflects the underlying business, which is the soy milk. And we can benefit further from the catalyst of sugar price. That is our approach, it's dual phase. For the last category, opportunistic, we identify certain companies that have very strong catalyst in the next 1 to 2 years. The catalyst can be from M&A activities or divestment of certain assets. We have one bank here which we identify they will benefit from a large divestment of non-performing loan, which has been there for the last 10 years. And it will unlock the value of the company in the next 1 year. However, the underlying business of that company is still very strong. So when we enter into this kind of company, we want to make sure that we only buy at the valuation of that underlying business. And the catalyst is the added value that we can get from the company.
And so when you look at your top 10, we'll show here both kind of year-end 2022 and then September 23 to kind of see how you've made some adjustments based on market conditions.
If you look at our portfolio, you can see several things. First, we are a very off-benchmark, bottom-up approach. All of our holdings have high convictions. The top 3 in our portfolio account for over 9% each. That is very high. The second thing is our concentration level is high as well. The top 10 in our portfolio now is more than 60%. Last year is 50%. So we increased our concentration rate further this year. The third thing that we want to point out here is our liquidity is very high. If you want to double the size of the fund in the next 1 week, we can do so because most of the companies, the liquidity is kind of excellent. If you want to triple the fund, probably it takes only 3 weeks, 2 weeks at most.
Are you putting pressure on me?
Sure.
Okay, thank you. And so, Phuong, what investment themes are you focusing on now?
If you attend the last year conference, we noticed that we were very cautious at that time. We sit on very high cash level, but then throughout the year, we slowly dispersed the money into the companies that benefit from the declining interest rates in the beginning of the year. So when end of last year, we sit on very low weight on financial. We actually increased the weight in financial, mainly some of the banks and then the brokerage companies. We also disperse the money into the companies that have resilient earnings growth during the challenging environment, which is technology, APT, while at the same time we reduce the weight in domestic consumption companies. But if we look at the portfolio, the FDI, the companies that benefit from the FDI and export teams are always our favorite. And during the year, we actually started to position the portfolio through the next year. So we are quite happy with the portfolio at the moment. So we already increased the weight in the export companies, which we believe will soon benefit from the recovery of export. And also, what I want to change, maybe, is to further reduce the cash and then disperse it into domestic, like consumer companies, and maybe increase the weight in technology and some selective real estate companies. Because I think we always find good opportunity during market volatility. Yeah.
So Mike, I don't hear you talk about themes as much. So the questions about how the exposure's changed in the past few months, what benefits, and how do you see the portfolio exposure changing in the future? And so, yeah.
Sure. If you see our portfolio, it is divided into 4 portions. The first part is the banking sector. The second is on industrials. Industrial here is mainly the port operator and the industrial park developers. The third part is consumers. It's mainly consumer staples companies. And the fourth is IT. We underweight real estate and materials significantly because we think that real estate sector, the difficulties will prolong. Since last year, we increased our weight in banking, in port operators, and significantly. You may have some question on the banking sector, why we buy now, why we increase rate significantly. We are aware that the difficulties are there. We know that NPL will rise, but we buy the banks that we believe have very strong capital adequacy, very good retail franchise, and we buy at the PE levels only 5. And we do not go there for the short terms. We are willing to wait and hold on for the long term. We believe the return on equity of our banks will be around 20%, so it's excellent long-term holders for us. For other companies, we try to increase the weight when we see the opportunities to accumulate FOL blocks are there. We accumulate lots of IT companies. We even pay very high premium. For certain banks, we pay premium as well. The outlook for next year, we are long-term investors. We don't change the portfolio that often. So you're likely to see the portfolio here could be quite similar to the end of this next year. Because we believe if the share price do not shoot up too much, then probably we will keep the same name. But one sector that we are looking at right now and we are very interested in is real estate sector. Because what we see is the undersupply is there. The only thing that we are concerned is which name to pick, and that takes us some time to find out the positions.
And so it's funny, I asked the question a bit unfairly because we talk about sectors and exposures, but the reality is you build the portfolio bottom up. This is a slide that we create to share with external audiences because it's just an easier way of kind of looking at the market.
Sure.
Okay. And so Phuong, actually, no, Mike, we'll stick with you. So can you give me an example? So as you're thinking about building a position, this is your top holding, Gemadep. Why does this stand out?
Sure. This Gemadep, which is the biggest port operator in Vietnam. For us, when we do the screening, it's easy to identify this company. Market cap below $1 billion. Liquidity is around $3 million, so it's fine. It satisfies our criteria. But if you look at the return equity, return on capital employed, it may raise your eyebrow. It's a little low. So that is where we come in as analysts. We need to check whether the numbers are correct or not. In this case, we think there's a big understatement on the income of this income statement of this company. Why? First of all, this company, they have many non-operating assets, which have been there for many years. And the value of this asset have not been reflected in the income of the company. So when you calculate the return on capital of this company, you have to exclude this. Because the core operating business should have much higher return on capital employed. We haven't counted the return on the appreciation in value of non-operating asset yet. And this company, normally they divest assets every 2 to 3 years, you will have some significant gain. So when you do the numbers, this should be adjusted up. The second thing is, for the port operator in Vietnam, they use the quick depreciation. So if you look at the depreciation over fixed asset, it's only around 7% for this company. So it means the average life is around 15 years. It's quite short for port operators, which have life of around 30 years. For some other ports, they even depreciate up to 7 years. I cannot tell you who, but this one is the biggest port operator, and we know that they use quick depreciation. So we have to adjust income up as well. So there's the 2 steps that we add in to reinstate the financial statement of these companies.
And so, Phuong, the same question for you. So maybe give us an example of a company that kind of represents how you think about building the portfolio as well.
As we talk about the Group 1 stock, there's a stock that I feel very confident in despite many different ideas of the market. FMC is one of the top, it's in the top 3 shrimp exporter in Vietnam. Last year, I think I already presented this company, but this year, I think my decision works quite well because it is one of our top contributors to the fund, and also it shows that during challenging market condition, you know, the export today was very tough, but the company kind of delivered outstanding business performance compared to its peer and its sector. But when we look at the company, when we screen it, it passed all our criteria. First one is a good business model. They have integrated production. They got growth consistency in both top line and bottom line. Can you show the next slide? When we look at the consistency, we see 5-year revenue and profit growth is at the top in the market, despite the volatility of the export market they are operating in. And when we talk about the industry tailwinds, actually we should talk about the shrimp exporter of Vietnam. We see that Vietnam has enough advantage in the farming as well as the labor force. We see Vietnam took market share from Thailand a few years ago, and then we are now compete with some countries that just focus purely on the raw shrimp. But when we add into the skilled labor force, then the high value added products of Vietnam shine in global market. And FMC focus mainly on that segment. So that's why they can grow very consistently. When we look at the valuation, we were able to purchase it at low price when the market feel not confident about the company, the industry, and also the management capability. So looking at forward, I think the company can grow at 15% each year. That brings the valuation to below average, its historical average.
And now there's another company you're going to mention briefly that you really like as well.
Yeah, PVS is another case. It's not perfect. It's in the group too. When we screen, it's got very low profitability and efficiency, but it has a reason. Because when we look at oil and gas industry in Vietnam, we see it was an underdevelopment in the last 5 to 10 years. But before 2015, the oil and gas company used to trade at good valuation. But we assess the company based on their asset. They have very good business track record in mechanical and construction service. They got very good facility in infrastructure. So now when the renewable energy industry is booming around the world, they immediately won some very large project. I was very surprised and impressed. So it's just the time. Can you move to the next chart? It was the time when we purchased the company right beginning of the re-rating cycle. So now you can see, if we look at the chart since 2023 going forward, I think oil and gas company like this one will outperform.
So, Mike, we talked about a company that's a good example of the core. Maybe expand one on the cyclical, and I'll mention VVF, which is the usage fund, was just upgraded to SFDR Article 8, which talks about and validates ESG integration. So maybe add a bit about where this fits into your analysis as using QNS as an example.
Sure. This is the number 5 in our portfolios. It's an upcom stock, so it's a very off-benchmark stock for our portfolio. If you filter this company, the data I highlight in red is the one that you should notice. It meets our criteria on market cap and liquidity. But when you look at market cap, this number is provided by many data providers. It is wrong. Why? Because for this company, they have treasury shares around 15%, but it's owned by a subsidiary. So when the data provider provide you the data, they do not deduct this. So we have to minus 15% from this market cap to come up with the right number. That is number 1. Number 2 is return on invested capitals. Our criteria is around 20%. This company, if you see this number is 16%, it doesn't meet it. But it's not correct as well, because this company has lots of cash, around $200 million. Then they do not deduct it from the excess cash from the return from the invested capital. That's why return on invested capital here is understated as well. That is our approach. It's worth to mention that although this is a cyclical name that we pick for the team, but actually we buy this, as I say earlier, the underlying business of this company is very strong. It has 80% market share in soy milk, and the price, the entry price that when we bought this stock, is mainly for the soy milk business. It can generate a 6 to 7% dividend yield alone at our entry price. The sugar business is actually valued at only 0 2 years back, because at that time sugar price was very low, and the company invested a large chunk of capital into sugar business, $200 million. But what helped the business is in 2022, 2023, the sugar price picked up. So you have all of this ecosystem of sugar plantation, biomass power plant, and sugar refining. They operate at a good level and bring high profit to the company. So this is the catalyst, the bonus that we have when we have the sugar business as a catalyst and its value at zero. And on the macro side, the government has been very supportive. They imposed anti-dumping tax on sugar imports from Thailand. This has a long-term impact because now sugar plantation can be profitable. And if sugar plantation farmers, they can make benefit from sugar cane, this company will be as well. So the policy will bring out the catalyst for the company. But anyway, this company, although we like it a lot and we see the value, but the growth rate of this company may not be as high as the previous company. The previous company, the growth rate is 20%. This company probably 5 to 10%. So that's why you see the weight here, we have only 5% in our NAV compared to the previous one is around 9%. For this company, is our example on the ESG approach as well. Thanks to Eric, we were granted Article 8 recently. It's very important for European investors, and it's a stamp of approval for our ESG integration in how we assess the company and how we bring about the best practice for certain companies in industries. QNS, they are listed in Upcom, and disclosure on Upcom Stock Exchange has not been good. The requirement is low, but we always encourage the company to join with investor for better disclosure. And the company has done excellent job in shareholders connectivity. They organize shareholder meeting very often, and the disclosure level compared to other Upcom stocks have been quite good. So although the ESG aspect, they still need to improve a lot. Firstly, on disclosure. Secondly, on environment. But we think that the company is on track, and we expect them to be listed on the main stock exchange in the coming time. Yeah.
Excellent. So, and I want to mention one thing that you said. Thanks to me, I was involved, but at the end of the day, it was due to the investment team, the research analysts, the portfolio managers, and importantly, we didn't change our investment process. You know, the thing here is in Vietnam, Morningstar, Sustainalytics, MSCI are not available, and so the burden of proof for us with, in this case, the regulators in Luxembourg, was really about being very transparent, sharing with them all of our research. So it's important to say that we didn't change what we were doing. We've been doing this for many, many years. We just had to show the regulators in Europe exactly what to do, and it took a while for them to do all the work. But I think it's very important, and for us, it's very validating to what we do. Now, a final question for you, Phuong. Certainly when I came here almost 4 years ago, and a lot of people ask the question or make the assumption, hey, you get 49% small caps, does that mean more volatility? And then I certainly did the research, and it didn't. Why do you think that is? And I'll just in case you're wondering, if the performance wasn't there long enough, it's back here now.
I think general perception is that small cap usually give us a lot of volatility, and yes, if we look at the market, shows in the presentation of a previous presentation, we show that in the Vietnam market there are more than 1,000 small cap companies, and a lot of that have the market cap below 10 million USD, and they actually have some speculative nature. But for VAF, as we look through historical performance and standard deviation, I think the standard deviation is not higher than VVF, which focus more on the mid and large cap. It is because we apply very thorough stock selection, and of course sound fundamental coupled with mindful of valuation, and that will bring us reasonable volatility. It helps us perform good in both upcycle or down cycle of the market in the previous 5 years. So I think the active approach in stock market of Vietnam is to work well for us.
All right. Michael, any closing comments for you?
We are long-term investors. If you look at the top quality names in the portfolio over the last 10 years, GMDF, the share price increased around 4 times. Vietcombank, the share price increased around 7 times. FPT increased around 9 times over the last 10 years. Those are the top quality names in the portfolio. How could they have done that? It's simply their earnings growth has been in the range of 15 to 25%. So if you do the math, if your earnings grows at around 15% in the next 10 years, your earnings will be 4 times in the next 10 years. But if your EPS grows at around 25% per year, in the next 10 years, it's at 10 times. That is our target, and this has been proven by certain holdings in our portfolio. Our main aim is to find those companies, high-quality companies that can deliver sustainable growth around 20% per year. 20%, you have around 6 to 7 times multiplier in the next 10 years. That is our target. And for Vietnam, we still find many opportunities like that. Although the market hasn't moved, it's still around 1,200 level over the last few years. But for the stock price of individual companies, that is a different story. The multiplier is much more than that. Yeah.
Thank you. And, you know, listen, at the end of the day, what people always ask, and the disclosure, at least from the US and much of the developed world, is, quote, past performance is not indicative of future returns. And the goal of us today on this panel is to say that past performance actually is indicative of future returns. And so as you look at the track record of both portfolios, again, we believe Vietnam is a market for active investors. We believe it's a market where active share will be rewarded. And I think certainly from speaking with Phuong and Mike and Tu and Lin that we know our companies very, very well. We understand how to build portfolios, and certainly the performance has been great. So we're going to take a quick break, but thank you all very, very much.